And then coming up at noon, there is something else that we will be watching that we have to talk about right now. And that is that hearing of the House Financial Services Committee. The folks who are going to be testifying before that committee include the CEO of Robinhood, Vlad Tenev, Ken Griffin, the CEO of Citadel, remember Citadel, the parent company for Citadel Securities, Gabriel Plotkin, CEO of Melvin Capital, the co-founder of Reddit, Steve Huffman, Keith Gill, aka Roaring Kitty, who was one of the folks who was a big supporter of GameStop shares and was one of the folks to initially publicly say it was undervalued. And all of them released their testimony. I know we've all been reading through it. And one of the things that sort of stands out, besides the fact that all of them sort of emphasize their humble beginnings and that they are not sort of titans of industry, although I haven't read Ken Griffin's yet, so it'll be interesting to see his spin on that. But as you pointed out to us this morning, Myles, they all sort of emphasized that they were not in cahoots, so to speak, that there was not a conspiracy theory behind either the touting of GameStop or the halting of trading of GameStop that happened when Robinhood in particular sort of set it off because they needed to essentially shore up capital because of so much trading over GameStop and some of the other meme stocks.
Yeah, and look, I mean, congressional hearings get called for all kinds of reasons, but a pretty good and common one is that lots of people are up in arms about an issue. It doesn't require that people are correct in their complaint about the issue, but we all remember when it seemed like anyone with a big microphone from pretty much any walk of life, any industry, anything that was kind of business adjacent, weighed in, and shockingly, everyone sort of took the side of this is the little guy fighting the big guy, and now the big guy is trying to put a stop to it. Well, there have been several stories about hedge funds that made hundreds of millions of dollars betting on shares of GameStop going up and then taking their gains as shares rocketed. So those sound like big guys to me. As Gabe Plotkin notes in his prepared remarks, Melvin Capital was out of the stock before the craziest moves even happened. They were done. I don't think he says the exact numbers, but basically, the stock got to 483 at its highs, hundreds of dollars per share before that. Melvin was outdone, not involved. They were done before the restrictions were put in place by the DTCC on what Robinhood and what some other brokers needed to have happen in their accounts to sort of get them shored up overnight. Additionally, and this is probably a conversation that continues beyond this, Vlad Tenev continues to talk about the need for T0 when, in my view, T+2 is what saved Robinhood's business. Also, Robinhood puts themselves in this position of creating margin accounts for customers that aren't trying to trade on margin by allowing instant access to capital that has not indeed come from your bank account to Robin's coffers, so on and so forth. All this to say, the hearing, in my view, is kind of called on this misguided sense that something nefarious happened here. And I don't think anything nefarious happened. There's no grand design. I think in many ways the system worked the way it was designed to. And I think, the initial testimony outlines what would seem to me to be the likely central tension here, which is lawmakers saying, did you conspire with X, Y, and Z to do A, B, and C? The answer is going to be, Congressman, I did not. Congressman, we sell ads. Senator
right.
sell ads. The famous Zuckerberg thing. Also, Keith Gill's testimony. He finishes it with, "I still love GameStop. I like the stock at these levels," which, Sozzi, just hilarious.
Yeah, definitely.
Yeah,
all right,
Go ahead, Julie.
I want to bring Steve Sosnick into the conversation here. He's chief strategist at Interactive Brokers because he's been living all this stuff as well. And so you obviously have a professional view of all of this as a strategist, as a trader, as somebody who works at an electronic brokerage, which I know you can't necessarily talk about the sort of business side of your business. But watching the hearing today, what do you want to find out?
Well, there's so much to find out. Unfortunately, I think they didn't ask the right people at first, because I would have really loved to hear from someone at DTC who could really explain what went crazy about the mechanics. I think the list of people they've got today don't really address the idea of T+2 or increased margining that came from the clearinghouses and why that came into effect in terms of causing firms to restrict buying in the stock. and the amount of systemic risk that was caused by this whole thing, which I think is really underappreciated. So while it's an interesting list of people, I think it's going to be more toward, the list seems to be more toward, addressing the politics of it and how this was a, in many, I consider this the market equivalent of, the riot at the Capitol. This was a populist uprising in the stock market, and they got those culprits, but they don't really have the people who can explain the plumbing that caused things to act the way they did.
Well, Steve, that raises the next question. Not much, really. Nothing happened to President Trump after the Capitol Hill rising here. So does that beg the question, after this hearing, does any changes come to how people trade stocks each day because of this hearing? Something is going to come of it, because it's at this kind of situation where you have to do something, Brian. But that's the part that people in the industry always get a bit scared about is, if they do something, is it properly intentioned and properly developed? That of course is the risk. I think that there's a lot of stuff that can be improved about the mechanics of short selling, stock borrowing. It is one of the truly opaque businesses that still remain in our industry. So much of what goes on in stock loan is a mystery to many people. Even I've learned a lot of things in this whole episode when I was doing some research about, how you can get short interest greater than floats. Short interest is reported every 2 weeks on a lag. That's nuts. And you can't really know what the stock loan rate is on something because it's a true over-the-counter market. So really hidden from people. And so that would be, to me, my focus would be, some of the stuff that Myles alluded to in terms of margin accounts, the stuff about stock loan. But I have a feeling it's going, of course, payment for order flow. That's a whole other animal. I think they will talk about that with Citadel. But there are so many issues here. But I have a feeling what they're going for is the idea that the little guy was hurt, and many little guys were hurt, but many little guys were really complicit as well. And so there's blame on all sides to go around. And so I just hope it focuses in the right direction. And I'll say I'll put my faith in Congress, but we'll see what happens.
Yeah, and just on the short interest point, Steve, I remember talking to someone one time about short interest, and I'll just say that they specialize in it, and their conclusion was that no one knows what the data actually is. And so I think we all learned a lot about that in the last couple of weeks. Steve, let's talk a little bit about what's happening in the markets right now, because we're seeing the second straight day of the NASDAQ under a little bit of pressure. There's been this question, when do yields start to really matter? How are you thinking about that dynamic? And are you seeing the pressure in tech as indicative of maybe a little bit more stress in the market than is being appreciated when it feels like stocks go up every day?
Yeah, I think, some of the pressure in tech has been, overshadowed in some cases by some of the rotation, particularly people who focus on the Dow, which has benefited from the rise in energy stocks and banks, as opposed to, the tech heavy indices, which of course are NASDAQ, and don't forget S&P, because the big tech companies are about 25% of S&P at this point. And what's been used to justify these, what I'm going to call stratospheric valuations, has been the fact that there's essentially negative real interest rates or very low nominal rates. And so having had a big run, it would not surprise me that some of the investors who are early into this game would be taking profits. It's human nature.
Steve, I want to ask quickly about the VIX here in 30 seconds, because I know there's been some talk about how elevated the VIX is even as stocks move higher. As I know there's a lot of plumbing stuff involved in the explanation, but if you could give us sort of a succinct one.
Okay, I'll try to do this in 30 seconds as quickly as we can. Basically, when you look at VIX, people compare it to the volatility of S&P/X, which is what it's derived from. But it's also derived from out-of-the-money options, puts and call, below market puts, above market calls, et cetera. Below market puts have always been a factor that's pushed VIX higher, because since 1987, there's been a skew and people have always wanted puts for protection. They learn the hard way that you need them sometimes. Lately, what we've seen now is there have been people clamoring for out-of-the-money calls. That's mostly retail driven. It's
hedge funds and other speculators as well. But those were always a little bit below the at-money vols because there were natural writers. I think now the weight of money that's flowing in there has pushed out of the money calls up. So you now have all these factors pushing up on VIX above the implied volatility that you would see in S&P. And that, I think, is going to make VIX harder to read if you've been used to reading it in a certain way for the last 20 years. And it doesn't necessarily mean more fear. It actually, in many cases, means more enthusiasm, which is why sometimes you see VIX go up when the market goes up.
Really interesting and an important lesson for people who have been looking at it for 20 years, like us. Steve Sosnick, Chief Strategist, Interactive Brokers, always great and clear on these really important issues for the market. Appreciate it, Steve.